Jim Casey is JPMorgan's co-head of global investment banking, also ran the company's efforts in fixed income for many years, and he joins us on the phone. Jim, good to have you to weigh in here on all things related to what's going on in the capital markets, particularly fixed income. Let me just start with the cost of capital for corporate America. It's clearly gone up this week. Is that something you believe is going to be a long-term phenomenon?
So, David, we've had a very significant and rapid repricing in credit, particularly high yield. And just for context, credit spreads have widened out about 815 basis points, or at 815 basis points, and the yields in high yield are now approaching 9%. So, in investment grade, it has been, I would say, more normal. Credit spreads are around 250 off. But I think that the biggest thing is that if you go back in time, I would say this is about one of the most rapid repricings that we've ever seen in high yield. So the question about whether this is the new normal, I doubt that it is, because I think that at the end of the day, defaults are going to be lower than the credit markets are implying right now. And the other thing is that the amount of dry powder sitting on the sidelines is remarkable. So you've got, in addition to that high yield funds, you've got private equity sponsors that are probably going to be redeploying some of their capital into the leveraged finance markets. You've got equity income funds, distressed funds, direct lenders. So I think that there are going to be a lot of people that are going to pile into this market.
You do, yeah. That's interesting. You mentioned PE, but there also may be a number of bankruptcies. I would imagine that that's certainly something that obviously is reflected in that increase that you're talking about in spreads, and is a possibility. Is that going to affect psychology as well?
Yeah, I think, look, defaults are running, over the last 12 months, are running about 3.5%. I think the biggest risk clients with respect to defaulting are the energy names. So energy now represents 10% of the high yield market. Most of the energy companies are hedged with respect to oil and gas prices. So I don't think the pressure on those companies is going to come until 2021. Our research analysts at JPMorgan have said that they think that up to 25% of all of the high yield energy companies may need to be restructured. So if that happens in 2021, I think you could have default rates go up to around 6%, but not out of line with historical norms.
What about downgrades from the rating agencies of investment grade companies? And so high grade debt goes to high yield. Is there enough buying power in the high yield market if, in fact, we do see a series of downgrades that actually forces some of those names out of other portfolios?
So I think that remains to be seen. So if you take the investment grade market, it's $5.5 trillion in size. 50% of that is triple B names. So those are the companies that are at risk for downgrade. So call that $2.75 trillion. If you compare that, the triple B names, to the total high yield universe of $1.6 trillion, it's about 170%. So we're not going to have downgrades of all of the triple Bs for sure. We will have some. I think it will be particularly energy sector focused. But, and the recent example we have is of Kraft Heinz, where $23 billion of debt was absorbed into the high yield market. But I think the bigger challenge that is less well known right now is whether the high yield investors will buy the long-tenored bonds of investment-grade companies if and when they get downgraded.
Because they typically don't do that right now, right? They only go out about 10 years.
That's right. That's right. High-yield investors usually like to buy credit at 10 years and in.
You mentioned PE firms potentially being buyers of this high-yield paper. I would assume, then, that they may not actually be borrowing money to do new transactions, at least in this environment.
I think that is the case. They certainly don't need to borrow new money. PE sponsors last year raised $300 billion of new capital. We think that they've got about $1 trillion of dry powder. So if you're a PE sponsor today and you look at the entire universe of LBO'd companies, you can probably get similar returns if you buy credit today that you would have gotten if they had done the LBO themselves and owned the equity.